As I mentioned in part one, we're going to demonstrate all the various steps of the budgeting process by going through a comprehensive problem. So we're going to start with looking at our sales budget, which also includes the schedule of cash collections, because it's not enough just to sell goods to customers. We also need to get the money for those goods, so we'll have cash to pay our bills. The sales budget really couldn't get much more simpler. The assumptions are the hard part, but again, those are given to us. So it tells us budgeted sales for the next 5 months are as follows, and the selling price is $10 a unit. So to figure out your sales budget, you're just going to take the unit sales times the selling price, and there you'll have it, the sales budget. So here's a sales budget for, it looks like, the quarter made up of April, May, and June. So this is like the second quarter of a calendar year. And to prepare the sales budget, we just take those budgeted sales and units, which were given, times the selling price, which was given, and you basically set it up and make it look pretty. So the total budgeted sales is the unit sales times the selling price for April, May, and June, and then we add those all together to get the answer for the quarter. Notice, though, for the selling price, we don't add the selling prices together. That's a constant. It stays at 10 on a per unit basis. But the bottom line is, all we do to get a sales budget is take our unit sales times the selling price. Then comes some more assumptions. So we have those sales. Now we got to figure out, when are we going to collect that money? Because we don't always sell everything for cash. You may remember back in Intro to Financial Accounting, we had sales on account. So sales on account mean customers buy stuff from us and pay for it after or later. So there comes more assumptions. Royal's collection pattern is 70% is collected in the month of sale, 30% in the month following. In April, the March 31st accounts receivable balance of $30,000 will be collected in April. So effectively, the March 31st receivable balance would represent the March sales that haven't been collected yet, right? So receivables are what has not been collected, whereas cash collections obviously are what has been collected. So we're going to start off with our April cash collections, which will start with accounts receivable from March 31st. And then to that, we're going to add the amount of our April sales that we expect to collect in April. And based on our assumptions, 70% of those April sales will be collected in April, 30% in the next month, which would be May. And then we're going to go through and do the same thing for our May sales. 70% will be collected in May, 30% will be collected in the month following May, which is June. Which brings us to our first quick check. Wants total cash collections for the quarter. So in order to do that, you're going to need to finish up this schedule. So going back to the sales numbers, we know that June sales are $300,000. So what you should do now is pause the video and incorporate June sales into this schedule, knowing that 70% will be collected in the month of sale, 30% in the following month. And then you'll be able to answer the quick check question. So pause the video and give it a go and see if you could figure out what total cash collections for the quarter would be. The answer is going to come out to be 940. How do you get that? Well, again, we're just adding June to the list. So 70% of June sales are collected in June. What about the 30%? Well, the 30% of June sales, so 30% times 300,000 will be collected in July, which means 30% times 300,000 or 90,000 is the accounts receivable balance at the end of the quarter. Remember, cash collections is what we do collect. Receivables is what has not been collected. And that's all there is to the sales budget and schedule of cash collections. It's really a function of doing what you're told in the assumptions. Now we're going to go and create a production budget, which tells us how many units we need to produce each period. So our sales budget and expected cash collections budget is complete. We're then going to do our production budget. We need our sales budget done first because that's going to drive production. We need to make sure that we make enough goods to meet the demand that we're predicting in our sales budget. In addition, we usually want to have a buffer because these are all estimates. So we're also going to have some type of desired ending inventory that we want to keep on hand. Because if, for instance, we think we're going to sell 100,000 units and we only make 100,000 units, if sales are actually higher than expected and we don't have any extra inventory, we're going to lose sales to potential customers. So we're going to always want to create a buffer, which would be our desired ending inventory balance. Again, more assumptions. Management wants ending inventory to be equal to 20% of the following month's budgeted sales in units. Then it tells me on March 31, which is the end of the last quarter, 4,000 units are on hand. That's important because the end of March would become the beginning of April. So our production budget is going to use a formula that's tied into our inventory formulas that we learned back in chapter 3, which would be beginning inventory plus purchases equals cost of goods available for sale minus ending inventory equals cost of goods sold. So we're using this formula kind of revamped to achieve the desired result. We're going to start with our sales. That effectively would be the cost of goods sold in units. Then we add back our ending inventory and then subtract our beginning because we're trying to solve for purchases. In this case, we're not buying it if we're a manufacturer, we're producing it, but it's along the same line. So whether it's a manufacturer or a merchandiser, we're either going to have to figure out a required production or a required purchases. So we're going to start with our sales because we at least need to have enough units to meet the demand of our customers. Then we add our desired ending inventory. Well, the desired ending inventory, according to the assumption which has to be provided to you, is 20% of the next month's sales. So all we're going to do to get the desired ending inventory is take, for April, is take 20% of May's sales. Why? Because the assumption said so. Beginning inventory would come from the previous month, and we were told that the March 31 ending inventory was 4,000. If we weren't given that, the only way we could figure out the beginning inventory would be to figure out what March's ending would be. Well, the rule is we want 20% of the next month. So 20% of April would be what we wanted our desired ending inventory to be at the end of March. And lo and behold, there's that 4,000. Now, it won't always work out that way. Sometimes we'll tell you what the ending inventory from the previous month was, and it won't come out to be in accordance with the assumptions like it did here, the 20% of the next month. And that's because actual results may vary from the budget. So if you're given a number like we were, the 4,000, you can just accept it. However, if you're not given that amount, then you can always calculate it because really it's just figuring out what ending inventory would have been in that previous month, which based on the assumptions is 20% of the current month's sales. So basically ending inventory is 20% of the next month in sales. Beginning inventory would be 20% of the current month. So what's required production in May? Give that a go. So to figure that out, you're solving for this circle right here. So pause the video and you could try it out. And if you tried it, you should have got the answer of 46,000. Why would you get that? Well, because you first calculate the 6,000, which is 20% of June, because at the end of May, we would want 20% of the next month. So this is 0.2 times the 30,000 in sales from June. And then the desired ending inventory from April would become the beginning inventory for May, because the ending in one month is the beginning in the following month. Likewise, I told you earlier that the beginning inventory is 20% of the current month's sales. So that also works. 20% of the 50,000 May sales is where the 10 came from. So that's kind of the mentality I use when doing this. If it's 20% of the next month for ending inventory, I do that for ending inventory, and I know beginning inventory is 20% of the current month. But if you've already calculated the ending inventory for the previous month, in this case April, it can just carry down to May. Likewise, the ending for May would become the beginning for June. And you can see there's that 6,000 right here. How do we get the June ending? Well, we need July sales because the month after June is July. So they gave us at the very beginning of this, the July sales, 25,000 units. And then we take 20% of that to figure out the number of units we'd want at the end of June. Then when we add things up for the quarter, it's important to note that the sales numbers get added together, because that's an income statement number, and income statements are for a period of time, but the inventory beginning and ending is just one number. You don't add it up. Where would the ending inventory from the quarter come from? Well, from the last month of the quarter, because the end of June is the end of the quarter. Where would the beginning inventory for the quarter come from? Well, the first month in the quarter, because the beginning of April is also the beginning of the quarter. So again, when you're adding up your budgets, it's important to remember income statement amounts get added together. So you add April, May, and June together, but balance sheet amounts are at a point in time. So it's either the beginning or the end of the quarter. You don't add it all together.